Hey, good morning, everybody. Today is Thursday, December 10th, 2015. My name is Cliff Backus, and this is your push-button-stock-trading.com daily video market review. Markets took it on the chin again yesterday, closing near their lows for the day on heavier trade and giving us distribution across the board. This was the third down day in a row for our indexes, and by far the worst of the three from the bulls' perspective. The S&P, which undercut its 200-day moving average on Tuesday, undercut its 50-day yesterday. The fact that the 50-day moving average is below the 200 is bearish, but the index undercutting its 50 is certainly a concern for the bulls. In perhaps a ray of hope for the short-term bulls, new lows easily bettered new highs, but by a considerably narrower margin yesterday. Also, while markets were down sharply, the ratio of bearish puts to bullish calls fell yesterday. Large capitalization stocks outperformed small caps continued to edge large on a 10-day moving average basis. Outperformance by small caps is more consistent with a bull market. Declining issues outpaced advancers by better than 3-to-1 on the New York Stock Exchange, and the New York Stock Exchange advanced decline line is showing weakness again. Technically, our market timing model fell to a don't buy signal by the narrowest of margins yesterday, but because futures are up at the time of this writing, we'll for now remain on a buy signal. This is a judgment call on my part, and typically those don't work out well, which is why we use a rules-based system. So take that under advisement. A buy signal indicates that both aggressive and conservative traders can buy, but we should not be increasing our margins on our portfolios at this point. According to Investors Business Daily, the O'Neill timing model is indicating that the uptrend is under pressure. The distribution count on both the NASDAQ and the S&P is very high, with 9 and 8 days respectively in the past month. Distribution, or higher volume selling, is a sign of institutional selling, and too much distribution over a short period of time can be an indication that the uptrend is in trouble. While both our model and the O'Neill model remain nominally on buy signals, our secondary indicators are showing signs of strain. While we always try to err on the side of optimism in the market, the bull market may be getting tired. As always, keep your stops in place on all long positions and be sure to follow your written rule sets. If you'd like help with portfolio management or with your written rule sets, please feel free to contact me. My contact information is on the home page. Okay, let's take a quick look at our spectrum analyzer. What we're looking at here is HGSI, High Growth Stock Investors, universe of over 8,000 stocks, sorted by a combination of the most powerful stocks and the most powerful industry groups. We've made a group of the top 100 stocks in that sort, so let's plug these stocks into our spectrum analyzer and see where the strength in the market is. Yesterday, of the top 100 stocks in our sort, 10 were from the real estate investment trust industry. We had 6 restaurants, 6 food and drug stores, 5 specialty apparels, and rounding out the top 5, we had integrated utilities and packaged foods, with 5 stocks each in the top 100. We've been seeing a considerable amount of real estate investment trusts recently. The rest of the stocks in our spectrum analyzer today haven't been showing up recently. So real estate investment trusts may be a good place to look for trading opportunities. Let's see what the Russell 2000 is up to. As we've been noting recently, the Russell 2000 is I believe, the key to the market going forward here. We've been watching the Russell put in this series of higher lows and higher highs as it's made grudging progress recently. I think it's very important that the Russell 2000, which yesterday closed at 1145, hold this minor support in the 1141 area and take out this resistance up in this area. That would continue the trend in the Russell of higher lows and higher highs, and that's what we need to see if this market's going to make a significant move higher. Let's see what the NASDAQ composite's up to. NASDAQ yesterday was down 75.37 points, or 1.48%. We closed at 50.22. Trading volume yesterday was higher than the prior day, giving us another distribution day. For you followers of William O'Neill, we are in a uptrend under pressure. We've been in an uptrend since October 2nd. But right now we have a total of 9 distribution days in the past month on the NASDAQ. I've been in this business for over 30 years. I don't believe I've ever seen 9 distribution days in a market that hasn't gone into correction. And as we've been noting, we have a lot of distribution on the right side of the chart. This is an indication that the uptrend in the market is in trouble. We have not technically fallen into a market in correction because we're still within 3.5% of the high in this current uptrend in the market. But I think that we want to err on the side of caution at this point. Right now, the NASDAQ composite is bracketed by support down here in the 4,900 area and resistance up here in the 5164 range. But notice the convergence right here between the 50-day moving average, which we show in red, and the 200-day moving average, which we show in black. A move by the NASDAQ down through that converging 50-200-day moving average would certainly be a bearish sign. The market's at an inflection point right here. We need to find support and we need to go higher. Otherwise, I suspect that we'll at least come down and test the 4,900 area in the market right here, and could come down and test this support down here in the 4506 range. Let's take off these markups. Right now our market timing system is on a buy signal. In order for our market timing signal to go to a don't buy signal, 4 things have to occur. First, the NASDAQ has to be trading above its 200-day moving average, which we show here in black. We're currently trading above the 200-day moving average. Second, our 10-day simple moving average, which we show in green right here, has to be lower than it was the prior day. The 10-day moving average right now is lower than it was the prior day. Third, our 21-day exponential moving average, which we show here in pink, has to be trading lower than it was 2 days prior. That also is trading lower than it was 2 days prior. And the final criteria would be that the NASDAQ has to be trading below this envelope, which is a 1% envelope around the 21-day exponential moving average. Technically, we're below that level. And so the market should technically be on a don't buy signal at this point. But I'm maintaining the buy signal because today the futures, at least as of right now, are significantly higher on the market, which means that the NASDAQ is probably going to open above this envelope. And so we're not going to go to a don't buy signal just yet. Let's take a look at the S&P 500. S&P yesterday was down 15.97 points, or 0.77%. We closed at 2047. Trading volume was higher than the prior day and was above average. That gives us a distribution day. Right now the S&P is in an uptrend under pressure, and we have 8 distribution days on the S&P. Again, we have this cluster of distribution on the right-hand side of the chart. This is an indication that the bulls are in trouble. Right now, the S&P 500 is bracketed by support down here in the 2044 area. Notice how we held that level of support yesterday. We'll see if we can continue to hold that level of support. The S&P yesterday traded below its 50-day moving average, which we show here in red. That's a little bit of a bearish indication. Right now we're trading below our 200-day moving average and our 50-day moving average. So right now we have to err on the side of caution in this market. Before we go, I want to cover a stop loss strategy. Remember, in any trading strategy, our number one priority is not to make money, but to not lose money. If we don't lose money, the making money will take care of itself. What we're looking at here is a chart of Facebook. We bought Facebook on this earnings gap on November 5th. Anytime we buy a stock, we put in an immediate 7% stop loss on the stock. And so we want to minimize our losses. We put in a 7% stop loss anytime we initiate a position. Then, if a stock falls below its 21-day exponential moving average, which we did yesterday in Facebook, we show the 21-day exponential moving average in pink. We put in a one-day stop at the low of that day. That's a preemptive stop. And that allows us to get out of the stock at this area before we actually lose the full 7% in the position. Hopefully that stop won't be triggered today, but we are going to put in a stop on our Facebook shares at the low of yesterday's session. That's about all I have for today. If you want to talk about any of the stocks mentioned today or any of our market strategies, please feel free to give me a call. Drop me an email or make an appointment. Come by the office, see what we're up to. Contact information is on the home page. Please take a minute to go to our subscription page and subscribe to Push Button Stock Trading. You can also follow us on Twitter at PushButtonStock. Again, my name is Cliff Backus. That's your daily video market review. Have a safe and profitable day. Keep your stops in place, and I will see you again tomorrow. Please stay tuned for our important disclaimers. All the best. Disclaimers. Push Button Stock Trading Video Market Review is produced and edited by Clifford B. Backus. Mr. Backus is a Senior Vice President of Investments, Technical Analyst, Portfolio Manager, and Partner with the investment firm of Ohanneson Liqueurs Incorporated. Video Market Review is produced solely for the benefit of our clients, friends, and colleagues. Anything written, stolen, and/or plagiarized in this publication is done without malice. Further, the analysis and opinions expressed in this publication are strictly those of the editor and not of Ohanneson Liqueurs Incorporated, its affiliates, subsidiaries, or any of the officers or employees of Ohanneson Liqueurs, Inc. On that note, we submit the following. The analysis, calculations, and evaluations presented herein are based on data and assumptions Ohanneson Liqueurs Incorporated believes to be accurate. Ohanneson Liqueurs Incorporated makes no representation that such analysis or calculations are accurate or that such valuations represent levels at which actual trades may occur. This report has been prepared from original sources, except where otherwise noted, and data we believe to be reliable. Ohanneson Liqueurs, Inc., its affiliates and subsidiaries, and/or their officers and employees or their families may from time to time acquire, hold, or sell a position in the securities mentioned herein. Moreover, opinions may differ from one entity to the next. If we are used in connection with the purchase or sale of any security discussed in this report, we may act as principal for our own account or as agent for both the buyer and the seller. Push Button Stock Trading is dedicated to the education of friends, clients, and paid subscribers. Push Button Stock Trading is an information service only. The information provided herein is not to be construed as an offer to buy or sell stocks of any kind. Push Button Stock Trading is created to aid subscribers in making informed investment decisions based wholly or in part on technical analysis. It's possible that at this time or some subsequent date, the editors of Push Button Stock Trading may own, buy, or sell the investments presented. All investors should consult a qualified professional before making any investment. The information provided has been obtained from sources deemed to be reliable but it is not guaranteed as to the accuracy or completeness. The editors of Push Button Stock Trading make every effort to provide timely information to subscribers, but cannot guarantee specific delivery times due to factors beyond our control.